On the podcast this week, we reveal the secret connection between low margins and poor cash flow. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6- and 7-figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancock, is a finance director, chartered accountant, and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow, and grow your business. So, Claire, I'm like, can you cough a bit less? And then you said, no, because it's really phlegmy and sticky. Nobody wants to hear that.
It's like the tail end. I've got it.
You've not been
22nd of December, I started coughing. And then by Christmas Day, I felt rotten, which is amazing because we had a house full of people that we were entertaining. And yeah, all throughout Christmas, and then maybe I think it was finally by about New Year's Eve, I didn't feel ill anymore, but I definitely still had a cough and a cold, didn't I? And it's lingering, even still. It's blooming annoying.
Yeah, I felt rubbish as well. It's one of those. It's been good. I mean, it's all over the news. This isn't the news story of the week. It's all over the news, isn't it? The whole thing about
flu cases,
hospitals being nailed by kind of flus, COVIDs, colds, everything. It's
because people don't go out anymore, though, do they? So they're not building up natural immunity. You're not getting exposed regularly to lots of different everyone's at home. Everyone's working from home. Everyone's getting online deliveries.
Have you been out in your car lately? No one's at home. It's just roads are gridlocked.
Honestly, people just don't go out anymore. They don't get exposed to viruses. So they're not building immunity. But what we did have when we were sitting in, not very well, is we did have plenty of time to respond to all of the wonderful comments on our TikTok page, didn't we?
All right, calm it. Yeah, we have to share these. This is tremendous. I mean, it pains me that we do a ultra professional business podcast with like stellar free education on it, where people can just, if they switch their right mind on, they can actually grow, learn. And, we get 400 or 500 TikToks each day on the shorts for the podcast. And then we go out with the Business Quizmas special and we're getting 32,500 views on each of them because they're just shit chat type of questions, whatever else. And not only that, but we're getting 40, 50, 60 comments on them. But wouldn't it be nice if people just put a normal comment? So I thought I'd read my top 4 comments from the TikTok shorts over the Christmas period. So rolling in at number 4, this was on the fact when we were having the conversation about the amount of people working and you misheard me and quoted something different, and somebody just wrote, finance director's maths on point then.
To be fair, I did make a bit of a miscalculation.
You did, it was fine, but how rude. There's no, they don't smooth out the comments, do they? My other one was just simply said, that top is horrible.
Yeah, I think that was my personal favourite, because to be fair, I always wear that top thinking, I'm not sure if I like this or not, but obviously other people are thinking the same, so maybe I might throw it away now.
Well, we were talking about people having Christmas off, and this comment just said, no bank holiday for drug dealers. I thought that was
I think that's one of my favourite ones.
Just so you're aware.
Yeah, just so you're aware. I am a drug dealer and I
probably
is
Christmas. One if he's on TikTok. And obviously my absolute favourite, which just simply said, bit off topic, but what cup size are you?
I just think, what does somebody think? Does somebody think I am going to share my bra size on TikTok with them or something? It's so bizarre that people think that.
Well, it kept me amused over the Christmas period. It got us a load more followers, but all of the wrong type. So as they say, it's better to have a small audience of good quality than it's to have a massive audience.
To be fair, we do nothing on TikTok. It's literally, we use an editing channel and it posts everything at the same time, like all the social channels.
It could scarcely be more the wrong audience. Having gone from never using TikTok, because I have to do the stuff for you, having to now see what's on TikTok, I am absolutely ashamed that is society that we live in, what's going on TikTok. It's just awful. It's awful. It has no value whatsoever. But
we've not had a single customer YouTube, or conversation with anybody on TikTok, have we?
I mean, on YouTube, the bar is extremely high. The type of people that are on there and the way that platform's used, it's different. But anyway, let's see what's in this week's news story of the week. So this week, I picked out a story which I thought was interesting, which was all about, it was called YouTube Stars Make Their Videos, I Make My Money. And this is really interesting. There's a company that I didn't know about called Future. And basically, how this works, they provide upfront payments to YouTube creators in exchange for the future ad revenue rights. So this model, I've heard this before, this model is very popular in music rights, isn't it?
Yeah.
So, they're basically taking the same type of model and transferring it to the whole world of YouTube. The problem is I think this has like tons of risks attached to it. You know, if you're totally reliant on the gatekeeper of YouTube as the platform that can completely control that ad revenue. So I just think this is immensely risky from a business perspective for this future company. Great for the creator, surely.
Well, this is what I said to you, because at any point YouTube could change their model and not pay content creators or pay content creators differently or control it or ban your channel or something like that. Now, I imagine Future are buying the content and not necessarily just the right to distribute it on YouTube. So I guess I would expect them to be buying the rights to distribute it on any channel. Otherwise, it wouldn't really make sense. But yeah, it's quite risky.
I read it and I thought, I kind of get it because I understood it in the music world, you know. So people, you always hear about, you know, Michael Jackson sold all of his rights, didn't he? The Beatles and people like that. And then, you know, these big pension funds or whoever venture capitalists buy the portfolio. And the idea is that over time it pays an income, and eventually, you know, it'll pay an income forever, so to speak, if they think the rights there. So therefore it'll be a good investment because eventually it'll pay for itself. So it says here, this model enables creators to receive immediate funds to expand their operations. So the idea is they get an influx of cash so they can then get bigger. So I think, is there a view from Future that by giving them that upfront cash, they're going to invest massively in the channel and the channel's going to grow even bigger? So therefore the return on investment's going to grow even further than the current projected ad revenue of the existing catalogue of videos?
Well, in the YouTube world, when you hit, I think it's 50,000 and then 100,000 subscribers on your channel, all of a sudden you get pretty much like a full-time person at YouTube whose job is to grow your channel for you. So you get all these additional stats, you get all these different pieces of information, reports, everything to help you keep getting your channel bigger and bigger. So they want to take, you know, if you've got 100,000 subscribers, your channel is already really big, essentially. But they want to then make those channels into 1 million subscriber channels, and YouTube will put huge amounts of money and time and effort to make that happen. So it's really interesting because we're looking at this and we're a bit like, oh my God, like, but is this just going to become mainstream?
I think potentially. I mean, they talk about some big artists here. I mean, God, I don't know these myself, but Future supports social media stars like the Sidemen, never heard of them, and KSI.
Yeah.
Helping them scale. I've heard of KSI, I don't really know a lot about it, but they are names though, aren't they? They're decent sized names. So
that's kind of like Mr. Beast style entertainment viewing those types of channels.
Which is where the big views come and where the big ad money comes. Like,
but it's interesting because we talk about this because we have Sky TV and we've now got Sky Stream. We used to have Sky Go and we now got Sky Stream. And Sky Stream is basically Sky are positioning themselves to be a content aggregator. And so when you go onto Sky Stream, it's actually quite clunky to get to the TV guide. You can't record programs anymore. It is just a streaming platform. And even like YouTube's now on there. And it means that we don't watch really any mainstream TV. You know, occasionally we'll watch a bit of Question Time or the news or something like that, but we're not really watching the terrestrial channels anymore. And YouTube has overtaken terrestrial channel watching, hasn't it? There's
a long time
far
ago,
more watches on YouTube and platforms like that. So actually, has this company basically bought the rights to essentially, I don't know, like ITV production? And if they did that, we wouldn't be batting an eyelid.
No.
But it's because it feels
new. It feels
risky, new. But YouTube's been around for donkey's years now. It's a very established platform. There's billions and billions of worldwide views every day. And actually, is it as risky as our minds are telling us?
I guess we're just worried because you read these horror stories about how, you know, click of a finger, an algorithm changes and your videos don't get watches anymore. And they're not doing this deal with YouTube. They're doing it with the creator.
The content creator,
and therefore there's just no protection. I mean, you saw what happened. There was a big thing where Apple changed their sort of security things and it screwed Facebook. Do you remember that many years ago? Absolutely screwed Facebook. And, you know, it only takes one of these people to do that and it's all gone. So I don't know how they're protecting against that and how they protect their investors against that. It sounds... for me, it would just be like, whoa, that is... I can't calculate that risk.
I think that is a really good point because it's like if you were trying to build a distribution business, you might use Amazon as a channel, but you would never want Amazon distribution to be your sole channel because
people always say against that.
Yeah. Or, you know, if you use Facebook groups, you don't want only your audience to be in a Facebook group. You want an email list as well in case Facebook shuts you down. And
ironically, talking about TikTok earlier, this is one of the stupid videos I saw on TikTok. It was literally some woman who was literally kicking off and crying in a video about she was slagging off TikTok Shop. But as she was going, TikTok Shop have ruined my business. She was crying, tears flooding down.
Well, but they get the most
done
views,
this,
don't they?
They take 12% of my business. I can't survive. And it was just this massive pouring of emotion on a TikTok video that turned up in my feed. I'm just like, this is not a business person, is it?
Yeah.
It was mental.
And I think that that's probably where I agree with you in terms of the risk, is that, actually most creators, they're making good money from YouTube ads, but then most of their revenue is coming from, sponsorships and advertising slots that they sell in their channel. So product placement and things like that, rather than the ad revenue that YouTube is paying. So it's quite a risk because actually if for a content creator, most of the money is from sponsorship and product placement and being able to sell products to your audience. So, for example, like on our YouTube channel, the hope is eventually that it's a lead generation and people come and buy accountancy services from us. We're not doing it because we want to make ad revenue from YouTube.
Otherwise, you make entertainment videos.
Exactly. So, but therefore, I don't think there are many people that create a YouTube channel with the sole purpose of making a living off the YouTube ad revenue.
Ooh,
I think most people
disagree with that.
I think most people go into it with the long-term goal of selling product placement, sponsorship, and things like that.
Really disagree with that. I see so many. I'm
talking about very low-level people, low-level people that
because then they
become a millionaire by starting on
then
YouTube.
They post their revenues and how they're getting on and all the rest of it. So I do think there's a huge amount of that. It depends on it. B2B, B2B is all.
It's different.
Yeah.
I think we're talking about the people that are like, oh, you can hand make some cookies at home and sell them at your local school. There's those very low turnover, low value businesses that are not really businesses. People have got jobs, and I think absolutely those people will be focused on ad revenue. But I think the vast majority of people that are doing serious, significant numbers on YouTube are not in it for the YouTube ad revenue. I think.
Oh, sure. The Daily Telegraph don't have a YouTube channel because they care about anything other than their overall
selling
brand.
The paper and selling marketing and advertising.
Yeah, their overarching brand. They're not interested in ad revenue. Yeah, I agree.
So therefore, the value of the ad revenue is far lower, and therefore that makes the risk to companies like YouTube higher.
Well, let's see. Maybe coming to a pension fund near you, so watch out for that if future's in your pension fund because it could be full of risk. Yeah. Right, let's move on to this week's deep dive. So this week, Claire, you are going to reveal for us the secret connection between low margins and poor cash flow. And there is indeed a connection, isn't there?
Yeah.
Tell me more.
So we work with a wide range of businesses. We've got what businesses we've got? So we've got estate agencies, we've got insurance brokers, we've got self-storage businesses, we've got removal companies, we've got transport businesses, we've got cleaning companies, food suppliers, we've got manufacturers.
There's so many.
So many software companies as well. And there is one common thread in all of the businesses that we work with, that cash flow is probably their number one issue. Don't get me wrong, cash flow is always a challenge in every business, especially growing businesses. But I'm talking about businesses that if they stopped growing and investing, would their cash flow be positive or not? And it's those businesses that literally it's like, am I going to get enough money in to pay my VAT bill? Am I going to get enough money in to cover payroll? So we're talking about operational cash flow.
It's a massive issue, isn't it? And if you reverse engineered everything you know about business now, your number one number you would focus on from day one is always cash. And it's exactly when we sat down years and years ago, like, we even called your company Profit Cash Growth. It was like, these are literally the three things that matter. We didn't, but
we called it Business Geek originally, exactly. And then we changed it.
But what became very apparent very quickly is that, when we went through the brainstorming, what is the number one thing that people constantly talk to us about is cash flow, cash flow, cash flow. It's the killer. Cash flow is the killer in business.
Not in all businesses, because I think the businesses that I work with tend to sit in two camps. They really struggle for cash flow. Or I have the vast majority of my customers sit in the camp of, I've got so much money, we just don't know the best way to spend it to grow the business. We don't know the right decision to make to keep the business growing and pushing forward in a profitable, cash flow rich way. So actually, you can sit in either camp, but I'm talking specifically about businesses now that struggle with operational cash flow. And what we mean by operational cash flow is that day-to-day cash flow. So you've got investing cash flow where you're, maybe looking at growing your business. So you might be buying assets and taking on loans and things like that, doing things that are going to have a longer term benefit for your business versus keeping the lights on day to day? Can you cover your VAT bill? Can you cover your payroll? Can you cover your rent? Can you cover your overheads? Can you pay your suppliers? That's what we're talking about when we say operational cash flow.
Okay.
And
so what type of business is a middleman business?
So
you're looking at me like
I'm looking at you like, yeah, you've got the question, because we don't pre-prepare this, but we do. What? I do give you some sort of like prompts and things like that. And I'm saying
you talk. What
I'm looking
at
you, giving you the
businesses.
eye. Yeah, so middleman businesses. So the businesses that tend to struggle, what I refer to as middleman businesses.
Right.
Okay, and a middleman business is one that sits normally bang in the middle of a supply chain. So you're going to have suppliers above you and other suppliers below you before you get to the end customer. Okay, so typical middleman businesses tend to be brokers, e-com businesses, anybody that does sort of distribution, so haulage businesses, things like that do distribution, anything like that, and also construction businesses.
Okay, yeah, they're somewhere in the middle of the supply chain.
Yeah. So those businesses are the ones that tend to have the biggest cash flow worries, but they're also the businesses that make the lowest profits. And that is the direct correlation between simply if you're making low margin, you can almost guarantee that you're going to have cash flow issues.
But isn't that because in many ways they probably didn't even exist and they shoehorn themselves into that part of the supply chain at some point to just take out further margin between, supplier A and supplier B?
And that's exactly
so
the point.
All you're doing is
the longer
watering down the consumer's, profit margin as it goes through the chain.
Exactly. So the longer the supply chain, the more people in that supply chain, everybody's got to take a margin. Yeah. So the margins in that supply chain get squeezed and squeezed and squeezed. And eventually, you literally, some of the businesses I work with make single digit margin on some of their services and products that they're selling, which is, as soon as you say, okay, we've got to hold stock or we've got to offer credit terms to our customers, you're absolutely screwed from a cash flow perspective.
Yeah.
So if you're a business, let's really simplify this from a numbers perspective. If you're a business that, so take a typical calendar month, 30 days, if you say make 10% profit margin in your business, so that's 3 days worth of your sales becomes profit, which doesn't, if you think how much overheads you've got to cover with just 3 days worth of sales, because normally the biggest overheads that a business has is people, and you pay people generally before your customers have paid you. Course, so if you're making 10% margin and that's only 3 days worth of sales and your 3 days doesn't cover your payroll bill, you're going to have cash flow problems without a doubt. So what we tend to see is that these middleman businesses have either high people costs because they're brokers and they've got people selling and hitting the phones and trying to do things like that. So that's a problem. Or transport and haulage businesses, fuel. It's very difficult to get payment terms on commodities like fuel. Yeah. So generally they find that they're paying fuel bills normally on 7 or 14 days. And if you've got delivery companies in your supply chain, then that's also a very significant issue because everybody gets squeezed because you're talking about literally the salaries of lorry drivers and the fuel bills, and all of those are paid pretty much up front. Yeah. And then stock. So they're the three things that I find tend to be the biggest challenge for the businesses that we're working with. And it's same in construction because you're paying subbies, and generally subbies you pay pretty promptly. You're not really taking 30 days with your subbies.
Now, a lot of people would say when they're in the core parts of these supply chains that they'd look at these and go like, these people have shoehorned their way in and they shouldn't even be there. We've got some in our industry. You just think you've created an industry for yourself by shoehorning your way in and trying to take people's margins and various other things. And you hope that the end user will drive that up to the consumer, but often they don't. They just take the hit in the middle, which isn't great. So rather than say, you can either say the business model isn't right or they shouldn't be there. But if they are there, what can they do about it? And is there something they can do to help improve the situation or fix the situation for themselves, for those people that are in that situation?
So the first thing that I would tend to look at is, first thing is we look at the cash flow of your business and we say, is this a symptom of the industry that you're in? Yeah. Or is there something we can do about it?
So basically, a controllable and non-controllable is what you're saying.
Because at the end of the day, if you're in the haulage business, you can only put so much margin on your fees because you're competing with so many people. So it's all very well me coming in and saying, well, your margin's not good enough, we need to make more margin. That's not a practical solution because you're just not going to be competitive and you're not going to win business. Yeah. So therefore, is your margin competitive for the industry that you're in? what can we do to put that margin up and up? But we will get to a saturation point where we can't keep improving it any further. So that's the first thing, is we optimise the existing business as much as possible for cash flow margin.
Right.
Once we've hit those ceilings, then we need to start looking at, okay, long term, we need to really start thinking about the strategy and the structure of your business and how we're going to move forward. So the most obvious thing to do is vertical integration. So what we're talking about here is buying up or down your supply chain. So, for example, I was having a conversation just before Christmas with one of our customers. They do supermarket deliveries. So they take products from food manufacturers and food producers and mostly deliver them into supermarkets. So they get the booking. If you make deodorant and you're selling into Aldi, so my customer goes and arranges a subcontractor to collect the goods and deliver them to the supermarket, but they're using subcontractors. So the first conversation is, okay, you could get your own fleet of vehicles. You could buy you could either put in your own assets, or you could buy a ready-made company. You could buy one of your subcontractors that you're paying to do the deliveries. Your subcontractor is going to be making 10, 15% margin. You're making 10, 15% margin. You could put those together and double your margin.
So, I mean, you could almost go into this as a pure strategy, which is you shoehorn your way into the industry as a middleman. Then once you understand the industry, you then look around, you then buy the players up around it and buy parts of the supply chain, and all of a sudden you're well and truly established in that supply chain.
Another really common one is if you're in like distribution of products or e-commerce, that type of thing, then you try and manufacture your own products. So you can either buy a manufacturer and make your own products, or you can even just have your own brand products. Often delivers a certain amount of increase in your margin, because if you've got your manufacturer, you've got your product creator, and then you've got your distributor. So you want to buy as many elements of the supply chain as you can, because every time you buy an element of the supply chain, that's margin going into your pocket, not somebody else's. So the most obvious thing to do is to look to buy up or down the supply chain for vertical integration. But that comes with risks.
And cost.
Because often the businesses that are struggling are doing this sort of middleman type of service, and when you go up or down the supply chain, you tend to move into products. So you become a manufacturer, or you become a truck runner. You go into
a skill set you don't have.
Exactly.
So you've got to then also massively upskill yourself to understand how to do those things.
Yeah. So the businesses that tend to be higher up in the supply chain and lower down in the supply chain tend to be more specialist. So, in haulage, there's, you can't just go and buy a lorry and stick it on the road. There's all sorts of licenses and requirements and legislation and things like that you need. And it's also not that simple to run a factory. It's really blooming complex to run a manufacturing plant, to source the right products and to manufacture efficiently and all of those types of things. It's a real skill set. Those businesses are far more valuable than these low value, low margin businesses that are sitting in the middle as a middleman.
Yeah.
But this far more risky. So it's an absolute fantastic way to increase your margin in your business, but it's very difficult to do.
Yeah.
In reality.
But it could be a good way of getting, like you say, getting yourself into an industry, really starting to understand that industry and upskill your knowledge before you then go on to buy the player that's in there, rather than go straight in and buy a player in a cold industry you don't have any skills in. So there's that element if you're going about it.
Yeah, that's a really good point. So thinking about like what I'm doing, for example, in accountancy, like one of the things that we struggle with is like platform fees. To really become a really efficient accountancy firm, it costs a lot of money and technology. We have what we call practice software, which runs our practice. It tells us, how many VAT returns are due, how many payrolls are due, how many tax returns are due, all of that type of stuff, what we've got to do every month end for our clients. And we've also got all the system fees for like Xero, Sage, QuickBooks, all of those types of systems as well. So therefore, if I was thinking my margin has been a bit squeezed here, what can we do? I would probably look to buy a software provider. That would be how I would probably get vertical integration in my industry.
Try and take away that biggest, look at what your biggest cost is and try and take away that biggest cost and bring it in.
Try and own that biggest cost.
Nice. Is there anything else?
Well, if vertical integration isn't right for you, then the other thing you could do is try and look to expand horizontally. And when we look at horizontal expansion, we're saying, okay, you sit in the middle and you have a customer base. So what other products could you sell to your customers? So I think, okay, me as an accountancy firm, I'm selling accountancy services to businesses of a certain size. What other services might they want? Well, they might want HR services. I could also sell in HR services, and there you looking more at economies of scale and getting value out of your customer list rather than trying to buy up or down your supply chain.
This is the car garage that then sells the
Insurance.
extra wax and
wax
I don't know,
and,
all those type of things, the upsells they sell alongside each other, or AO that sell you the insurance and the warranty and the whatever else.
Yeah, so
these
to build
out your supply chain that way.
Businesses that are selling to a similar customer base as you that you can buy, and it has twofold benefits because firstly you gain a new customer base. So if I was going to look to buy a HR company, I'd be looking for a HR company that has a similar customer base to me, so I'd be buying those customers because they would also buy accountancy services. And or I would then be able to sell HR services to my customers too. So you get like double bubble. You want to be able to sell your services to the HR business, and the HR business sell their services to the accountancy businesses. Does that make sense?
Yes.
So the easiest and probably on paper, the best way to increase your margin is to look at supply chain integration and buy up or down your supply chain. Yeah. But that's hugely risky because you're going into a completely different skill set. It's not what your business is set up to do. So actually, I tend to think that the lowest risk is to go for the horizontal integration.
So maybe you should do it on the basis of starting with the horizontal and see how successful you are with that and whether that can generate or not. Because it's not always, it's not always traction in that. And and you might hit on something or you might not. And then if you're really struggling, then look at the meatier things, the vertical integrations that you can buy in terms of bringing them in.
Yeah, absolutely.
Nice. Great. Well, thanks for that, Claire, and revealing the secret connection between low margins and poor cash flow. And I do believe that this week you've got us a profit cash growth extra.
I have. So our listeners will know that Simon and I like to travel a lot. In particular in December, we spend most of it in Tenerife, but work does not stop for us. It's not really a holiday. It's more just like a relocation of our life, isn't it? And being a numbers person, I cannot work from a laptop screen. It's simply impossible. Excel spreadsheets are far too small on my screen, and I just need two screens to be efficient. And I bought from Argos, it was £70. I was a bit dubious because of the price of it, but it was a portable monitor, and it's a little bit bigger than my laptop screen. It's 18 inches and it was bloody phenomenal. It absolutely did the job of having a second screen. It is so thin, it's like the size of an iPad, and it's powered off my laptop. So I plug it in with a USB-C to my laptop, and it is powered and it sends the display all in one cable. So it's super portable. And I just thought it was really, really incredible. When we're working on site with clients as well, it now means that I can take a second screen with me. Maybe sometimes when I'm doing like board presentations on site and things like that, it just means that
they work as a presenter, don't they? It's so light, isn't it?
Exactly.
Well?
And it just means like a lot of small businesses that I work with don't necessarily have like a formal boardroom set up with a projector or a TV or something that you can connect to. So just having this extra screen just means that when you're sitting in a room with people, you can make sure that everybody can see something that you're presenting as well.
You know what this has made me realise of late with a couple of things with that screen, and you bought a phone recently, like a smartphone, and it cost literally nothing. And I think we've got so accustomed to the branded technology of the Apples and the Samsungs and whatever else, of being £1,000 a device, or an iPad being £1,000 for that screen and various other things, that we forgot how cheap the technologies actually come down to. Would you take the brand away?
Yeah, do you know what? Before I bought this 18-inch monitor, I actually bought a 20-inch monitor originally from Amazon, and it was like £110. And it came, and I swear, it felt like a TV. It was phenomenal quality, the weight of it, but I sent it back because it didn't fit in my laptop bag simply. So I would have had to have carried it separately to my laptop, and that would have annoyed me. So I sent it back and got a slightly smaller one. But I was blown away by the quality, and it's the quality of the screen. The screen is as good, if not better than
it's really come on. I think
my laptop.
I think your head just remembers like these screens like 5 or 7 years ago, and they've just, again, everything just continually moves on it, and you revisit it and you're like, wow, that is amazing. Actually, I saw them coming up with those, talking about that on TikTok. Again, I don't want to talk about TikTok too much, but it's again those little like light monitor screens and things like that. So it's just all this stuff coming out of China is just like coming out at a rate of knots, isn't it? And it's just such high quality. This is why they're the largest electric car manufacturer and all this. They're just going to take over. It's just going to continue to get better and better, isn't it?
They're brands that, I've never heard heard of before. Most of it is Chinese import. But do you know what I really like about this in particular is for my team, I have got into the habit of buying everybody a monitor for their home. And then in the office, we make sure that we have desks set up with mouse, keyboard, monitor there as well. So it means for every employee, I'm buying 2 monitors, one for the office and one for home. But this is so light and portable. You literally just unplug it and slip it in your laptop bag.
So it's just cost saving as well.
Yeah. And
amazing.
It's good enough to be an everyday monitor. It's absolutely phenomenal. So I bought mine from Argos, but I also bought one from Amazon too. So do check them out. 18-inch monitor, about 60, 70 quid. Absolute bargain.
Yeah. So you could take an 18-inch, but you can't take a 20.
It won't fit in your laptop bag.
Thanks for joining us for the podcast. I hope you enjoyed the finding out about the secret connection between low margins and poor cash flow and all of our other shit chat of the day. As always, if you feel like you might have outgrown your current accountant and you might like to work with Claire and the team at Profit Cash Growth, you can find out more about them at profitcashgrowth.com. On there, you'll find all of the podcasts, you'll find blogs, you'll find a free resource library you can log into and find lots and lots of information. And then if you do want to book a discovery call with the team, you can do that as well. Please rate, review and subscribe to this podcast. And as always, just share it. There's a little share button, I'm sure, on the platform you're using. Just share it with one other person that owns a business and just tell them to get involved and lap up all of the free education that we put so much of our time into every week. And we will see you again next week.